Welcome to Trading Essentials channel. In this channel we are dedicated to help the traders who are still struggling to become consistently profitable traders. The topic we're going to discuss today is how to use chart patterns along with Fibonacci retracement to execute our trades. Many people will ask why the chart pattern of technical analysis is effective. And if you want to solve this problem, you must immerse yourself in the meaning behind these chart patterns. So, let's discuss in this video. First of all, this morphology we trace back to Richard Schaebacker came up with. It was first proposed and then applied to the stock market. In fact, our ancestors helped us to summarize that these morphological characteristics are valid in technical analysis. So, what's the meaning behind it? Chart pattern, which is a statement that we can see with our naked eye. And it can also be called a collection of human nature or a combination of market sentiment or a collection of trading behaviors of a group. Behind every chart pattern is the psychological price of human nature. If we don't understand why these patterns play a role when we are trading, then the efficiency of your trading will be greatly reduced. So why do I say that? When we know what is meant behind each pattern, then our trading becomes simpler and simpler because we know that we are trading not patterns but human nature. Our video today will explain to you what's the meaning behind each pattern and how we can use them to help us achieve profitable results. This video shows how to trade chart patterns along with Fibonacci retracement. Because in the previous video, we mentioned how to trade chart patterns along with Fibonacci retracement. So today I will do a separate video to explain. This video covers a summary of years of experience and this should not be free. And if you get some value from our video, don't forget to subscribe to our channel and turn on the notification bell to receive our latest video. First of all, let's learn from the simplest chart pattern and most people who will learn when they first come into trading, which are double bottom and double top. The principle of double bottom is actually not difficult to understand. Sometimes we will see this pattern in the end of the downtrend, when the price continues to fall and first reaches to this area and form a lower low. And then the price come back to this area again. Some sellers will see the rejection candlestick and feel that the price cannot break through the previous lower lows. So they choose to take profit in this area. Some buyers will feel that the price has formed a bottom and see the strength of the buyers participants, so they will enter the market when they see this candlestick. Therefore, with the cooperation of both sides, this pattern gradually arises. If you are a beginner who is watching this video, I actually do not recommend that you enter the market directly after seeing this pattern, because this pattern is everywhere in the market. If you trade whenever you see double bottom or double top patterns, it will lead you to overtrade. It's not hard to see the neckline in the middle of the double bottom. My advice is to wait for the neckline to be broken, or after the breakout of the pullback will be more suitable for traders who have just entered the market. My advice is to wait until you have experience or have undergone a lot of back testing and have been verified before you consider using other methods. Now we can observe the neckline has been strongly breakthrough. Once the double bottom neckline is broken, we need to pay more attention. But today the way I shared is to trade along with the Fibonacci retracement. So, I will not explain how to trade with breakout. If you are interested in understanding how to trade with breakout, you can leave a command below the video to let me know. If there are a lot of people who want to know about it, we can also consider making a related instructional film. The neckline that we just focused on has now become a resistance. Because the price has formed a bottom and is strongly broken, at this time we can get some information from this chart, which is that the buyer is now dominating, and the price has a relatively high probability that it will continue to run upwards. Now we can use Fibonacci retracement to pull from the lower high to higher high. We can find that the Fibonacci retracement 0.5 perfectly matches the previous neckline, so we can directly set our buy limit at 0.5 and set our stop loss at 0.786 and take profit at 0.618. Such trading is more advantageous for new traders because we can clearly confirm that the bottom has been broken and trade only when the pullback occurs. The certainty will also be relatively high. This is almost a 4-to-1 risk-reward ratio trade. Now let's look at the case of double top. Double top and double bottom principle is the same. So I will not explain the principle of double top formation. Let's look directly at how we should trade with this double top. Firstly, we can notice the price creates a higher high, and then we can see that the price is trying to break through the higher high. but it is clear that the buyer has failed. Then we may observe the gradual strengthening of the seller's power and easily break through the neckline. With this time, we can get some information from this chart which shows that the seller is now dominating, and the price has a relatively high probability of continuing to run downwards. Now we can use Fibonacci retracement to pull from the higher low to the lower low. What we see now is different from the previous trade. When we trade, we encounter different situations, so we have to know how to deal with different situations in the market. We can observe that although the price is not accurately standing at 0.5 or 0.618, it is not difficult to find that the middle of 0.618 and 0.5 is a good trading area, so we can directly set our sell limit in the middle of 0.5 and 0.618 and set our stop loss at the middle of 0.786 and 0.885 and take profit position at 0.618. Next, we can see a pattern that is easy to identify, and I believe that it is not difficult for traders who are following our channel to find this pattern. Now we're looking at a head and shoulder pattern. Why many traders will tell you that the head and shoulder pattern is likely to change from an uptrend to become a downtrend? Now let's take a look at why most people say this, what it means and what causes people to think of head and shoulder pattern as an uptrend or downtrend ending. First of all, we can observe that the price successfully created a higher high, but a healthy trend did not last, and we saw that the price came to the vicinity of the higher low. At this time there will be a part of the buyer who will feel that this is not a pullback of the healthy trend, so they will consider taking profit early and cause the buyer's power to gradually decrease. Then we can observe that although the price has not continued to run downwards, the momentum of the price is not enough to continue the uptrend, and we can clearly observe that the seller is beginning to dominate, and the price gradually falls and causes the price to fall below the previous higher low. So, at this time we can know that the price will have a relatively high probability of running down. Now we can use Fibonacci retracement to pull from the previous lower high to the lower low. What do you think is the best area to enter? I'll give you 5 seconds to think about it. 5, 4, 3, 2, 1. Is there anyone whose answer is in the middle of 0.618 and 0.5? In fact, we have a better choice that is, the middle of 0.5 and 0.382. Why do I say that? This is because we can see that the support and resistance behind are more critical, and we can easily observe the trend line here. So, the area between 0.5 and 0.382 would be a better choice. After the explanation of the last cases, I don't know if anyone can now observe what the pattern we are looking at is? I'll give you another 5 seconds to think. 5, 4, 3, 2, 1. Now we're seeing the inverse head and shoulder pattern. When we trade, we actually see more of this messy pattern, and cases like the previous chart will not appear very often. So, we need to train a lot of time so that we can easily identify some of the patterns that look messy in order to make our trading more efficient. The first thing we have to pay attention to when we identify such a pattern is the breakout of the neckline. Once the neckline is broken, we will be able to get a lot of information from this chart, because it may represent a trend reversal. We are now able to observe the price break through the neckline of the head and shoulder pattern with strong momentum. At this point we will be able to use Fibonacci retracement to pull from higher low to higher high. Now people would ask why I chose this higher high instead of this area. This is because the price here does not meet the minimum requirement of 0.382, so I will not choose to use this higher high. We have to have our own rules when trading, so if the price doesn't pull back to 0.382, which is the minimum requirement in our rules, we don't consider executing our trade. If there is someone who doesn't understand, you can go for the Fibonacci retracement instructional video on my channel. There will be a better explanation about how I use Fibonacci to trade. So now we can clearly see that the Fibonacci retracement 0.382 perfectly coincides with the important area in front of us, which is our support area. Now we just need to set our buy limit, take profit and stop loss. In my video you can see that we always maintain a high risk-reward ratio. But a lot of new traders like to take profit early and keep their losses running. This is a very bad behavior because they only focus on short-term behavior that is satisfied with the present moment. However, professional traders will not try to take profits in advance to temporarily please themselves, but we will always wait for the opportunity to come. But when the opportunity came, we already had a complete plan to know what kind of action we should take. Now we come to another case, and this pattern is the one that I like to trade very much. So why do I say that? There are three types of triangles: ascending triangles, descending triangles, triangles. The principle behind these triangle patterns for me represents the fear of people's psychology. I believe that everyone has heard, be fearful when others are greedy and greedy when others are fearful. So, the triangle pattern is a pattern for me that represents fear. Because we can observe through the charts we see now that buyers and sellers are trading less and less, slower and slower. At this time we can observe that neither side is willing to trade a large position of trade. But there will always be an outcome in a long-term game between the two sides. So when the result comes out, it's when we should be greedy. Now we are looking at the ascending triangle. So, in this pattern we can observe that the seller's power is getting less and less and the buyer's power is maintained. Then we can observe that the price has strongly broken through the triangle we drew. And with this time we just need to wait patiently for the price to pull back and execute our trade. When we trade, we must be very clear about what we need to plan for next. Now we can use Fibonacci retracement to pull from the previous lower high to the higher high. I believe that some traders watching this tutorial video will ask why I used 0.618 instead of 0.5 to enter the market, because I will make sure that my entry position is at the key price of the support and resistance or trend line. The more confirmations there are, the more secure such transactions will be. Go through the previous case. I don't know if anyone is able to observe the pattern we are seeing right now. Yes, it's a descending triangle. Inside this descending triangle we can also clearly observe that buyers and sellers are trading less and less, and the speed is getting slower and slower. The descending and ascending triangles are inverted. We can observe that the power of the buyer is getting less and less, but the power of the seller is relatively constant. Through a long game the price successfully broke down. That's what we'd love to see. Similarly, we only need to wait for the price to pull back before we can consider executing our trades. Now we used Fibonacci retracement to pull from the previous lower high to lower low. It can be found that the 0.5 level is a key level with support and resistance. So I will directly set the sell limit at 0.5 and then set my stop loss at 0.786. Finished with the ascending triangle and the descending triangle cases. Now let's look at the ordinary triangle pattern. The ascending and descending triangles are not the same as ordinary triangles because in the shape of the triangles the strength of the buyer and the seller are almost the same. But it is not impossible for us to predict the direction. We can see that the price has a strong rise before the price forms a triangle pattern. So when we see this triangle formed, we can expect an upward trend. Then we can observe that the price continues to converge and strongly break out as we expected. So, we just need to wait for a pullback before we can consider entering the market. So, we were able to use Fibonacci retracement directly to pull from the previous higher low to higher high. We can see that Fibonacci retracement 0.618 fits perfectly with previous resistance. This key level is broken and then it becomes the support that we need to pay attention to. But we can see that the price did not successfully reach our target level, but only reached 0.414 and then fell back to the range where we first traded, causing the trade to change from profitable to break-even. This is what we can't control. So we can only focus on where we can control, which are our own discipline and trading rules. After I explained these patterns, someone would ask why I did not mention the example of an expansion triangle. The expansion triangle is inverted to the convergence triangle. The convergence triangle is a fearful pattern for me, but the expansion triangle is a greedy pattern for me. So, I'm afraid when others are greedy. I also don't trade expanding triangles because through this pattern we can see that both buyers and sellers are very greedy, which is difficult for us to predict. Of course, there are also traders who are very interested in expanding triangle trade. But I don't recommend new traders to participate in this kind of trading because the certainty will be lower. If you have any thoughts on this topic, you are also welcome to leave a comment to let me know. Now what we're seeing is a parallel channel. So how should we trade parallel channels? In fact, the parallel channel is very similar to the trend line. If you have seen our previous video, The explanation of the trend line should not be too strange. When we use a parallel channel, I wait for the third touch point before I execute my trade because it ensures that we are trading in line with the trend. It also corresponds to what I said earlier in the trend line video that the third touch point represents the fixing point and the verification point. We used Fibonacci retracement to pull from the previous lower high to lower low. We can clearly see that 0.618 matches the trend line perfectly. We can also observe that the support and resistance are also close to the same location. So, it's very important area to me. We can set the sell limit to 0.618 and the stop loss to 0.886. Now let's look at the ascending channel. A rising channel and a descending channel are the same trading methods. Now we see that prices are constantly rising and continuing to create higher highs. We just need to wait for the third touch point of the price in the channel. We are able to execute our trades after we confirm that the third touch point is verified. We were able to use Fibonacci retracement to pull from the previous higher low to the higher high. We can observe that the price fits the Fibonacci 0.382 level. So, we can set our buy limit directly at 0.382 and our stop loss at 0.618. In this way we can get a high risk-reward ratio of trades. I don't know if anyone can see what pattern this is now. If you see this pattern should be a little familiar to you. Now what we're seeing is the triple bottom. We can observe that a triple bottom has formed at the bottom of the price. Some of the smarter viewers should be able to observe this pattern as quickly as I do. Why did I put this pattern at the back of the video? Since I have already explained double top and double bottom earlier, I hope that the final pattern can be easily recognized by everyone. Triple bottom and double bottom trading methods are actually almost the same. We just have to wait for the key area to be broken before we can take action. Now we can use Fibonacci retracement to pull from the previous higher low to the higher high. We can see that the price fits the previous support. So why don't I choose to trade with 0.618? Because we can see below the price that there is also a trend line and also reached the third test. So, the best choice would be 0.5. Now what we're seeing is the triple top where we can clearly see resistance formed in the same area. The price tested the same area for the 3 times in a row but could not break through to form a new high. But instead broke down the neckline. At this time the market has relatively clearly told us that the sellers are dominating. So, we just need to wait for the pullback after the price breakout to execute our trading plan. Now we observe a pullback in price to 0.618. Why would I choose 0.618? Because I don't usually go and use the area above 0.618 as my entry position. So, 0.618 will be my last resort. In this trade we can also see that the price did not successfully reach our take profit position and return to the area where we entered. With this time, we can only accept. The only thing we can control in this market is ourselves. So when this happens, we can only accept and prepare ourselves for the next trade. In the end of the video, I would share some mindset sharing. Think before you trade and don't think after you trade. A lot of time, new traders don't have a plan to trade and they trade based on their feelings. So, we need to train ourselves to trade without emotion. Also, traders like to check their orders all the time after they have execute their trade and become agitated. So, we need to train ourselves to become patient. If you learned some value from our video, don't forget to like, subscribe and share. See you in my next video and hope you guys have a winning streak throughout the week.